TPG may have a monetary relationship with the credit card companies.
Welcome back to PowerPointers 201. Today we're busting some myths on having too many credit cards. How many credit cards do you have? 1, 2, 5? If even the thought of managing multiple accounts makes your head hurt, you may want to sit down. As of today, I have 23 open, active credit cards. And yes, it does take time and effort to manage these multiple accounts. But there's one question, more than any other, that I get anytime someone hears that I have nearly 24 open credit cards. What about your credit score? Well, today, I'm here to debunk some myths around how having multiple credit cards can actually be a boon for your financial well-being. As of today, my credit score is, wait for it, 832. In fact, it hasn't dropped below 820 in over 12 months. For reference, credit scores typically range from 300 to 850, so I am at the tippity top of the range, technically in the exceptional category. But here's the thing, there's nothing exceptional about my credit card usage. I'm not spending hundreds of thousands of dollars a year. I don't know some secret hack to tricking the credit bureaus to raise my score. Instead, there are some clearly established ways that you can leverage new credit cards to boost your score. And that can pay off, like literally pay off in the long run. First, a disclaimer. Never, ever use credit cards to spend beyond your means. Pay your balances in full and on time every single month. Not doing so could result in massive interest charges, late payment penalties, and most importantly, a serious drop in your credit score. With that out of the way, let's take a closer look at exactly how your credit score is determined. While the exact formula is proprietary, we do know that there are 5 factors that go into the calculation: your payment history, amount of debt, length of credit history, types of credit, and new credits. So yes, applying for a new credit card does have an impact on your score, but it's a small one, just 10%. And it's also temporary. When you apply for a new credit card, it'll typically result in what's known as a hard inquiry on your credit report. Essentially, the issuing bank, whether it's Chase, American Express, or Capital One, is checking to make sure that you are a worthy borrower. And when that happens, you'll typically see a small drop in your credit score, maybe 2 to 8 points depending on your situation. But these inquiries are temporary. They only stay on your credit report for 2 years. Now, let's talk about the other more significant factors of your credit score, starting with your payment history. Here's how FICO, the most commonly used score for lending decisions, describes this aspect of your credit history on myfico.com. Payment history shows how you've paid your accounts over the length of your credit. Research shows that your track record of payment tends to be the strongest predictor of the likelihood that you'll pay all debts as agreed to. If you have a single credit card, you essentially get 12 times per year to show the credit bureau's positive payment history. If you have 5 credit cards, you have 60 opportunities. For me, I get 276. Now, that's not to say you should strive for 23 cards or even 5. But each additional installment loan, which includes car loans as well as mortgages, can be another opportunity to show the credit bureau's positive payment history. But it's the second most important aspect of your credit score, the amount of debt, that can be impacted even more by adding a new credit card to your arsenal. In short, the amount of debt portion of your credit score, which is often referred to as credit utilization, is the percentage of your total available credit that you are using at a given point in time. For example, let's say that you have a single credit card and it has a credit limit of $10,000. During a given month, you're using about $4,000 of that available credit. In this case, the calculation looks like this. $4,000 divided by $10,000 equals 40%. Your credit utilization is thus 40%, which is considered relatively high. 30% is generally the recommended maximum, but an even better one is 10% or even lower. Now, let's say you apply for a new credit card and you're approved with a credit limit of $30,000. Even though you're still spending that same $4,000 every month, you've now quadrupled the total available credit to you. The calculation then becomes $4,000 divided by $40,000 equals 10%. Just like that, the new credit card cut your utilization significantly, and this will boost your credit score tremendously. For me, my 23 open credit card accounts give me a total available credit of over $300,000. And because I'm only using roughly $4,000 of that on a monthly basis, my credit utilization is less than 2%. So, what does this mean for you? First, don't be afraid of applying for a new credit card. Yes, it may result in a small dip to your credit score, but that's only temporary, and it will be more than offset by the additional available credit and opportunity for immaculate payment history. Second, if you aren't ready to apply for a new credit card, consider requesting an increase in your credit limit on an existing card. Though it's important to make sure that your credit card issuer will not run your credit in order to fulfill that request. And again, be sure that adding a new credit card or getting a credit limit increase will not result in spending beyond your means. Pay your balances in full and on time every month. It's true that I have 23 open credit cards. It's also true that I have an exceptional credit score, 832 at this point. Now, you may think this is crazy, or genius, or a combination of the two, but one thing is for sure. By responsibly managing your credit, adding a new credit card to your wallet will absolutely increase your credit score in the long run. I'm Nick Ewen, and this was PowerPointers. We'll be releasing new episodes regularly, so click subscribe below to be notified each time a new one launches. Until next time.